Auditors, controllers, and treasurers, along with our colleagues at the Association of Government Accountants and the Association of Local Government Auditors. I'd like to welcome you to today's webinar on GASB 68, Accounting and Auditing Issues. Implementation is coming soon. My name is Kenny Pointer, and I'm the Executive Director of NASAC, and I'll be serving as your host for today's event. We're joined today by approximately 1,400 government accountants and auditors and other interested parties from 117 different locations across the United States. As all of you know, the Governmental Accounting Standards Board new pension standards, GASB's 67 and 68, present various implementation challenges for both accountants and auditors, for employers, pension plans, as well as auditors. For the first time, employers will recognize their share of the pension amounts for all benefits provided through the plan, including the net pension liability, deferred outflows of resources, deferred inflows of resources, as well as the pension expense. For most states, GASB 67 was effective for fiscal year ended June 30, 2014. Most pension plans have implemented the provisions of the new standard, and auditors have completed their audit of the plan's financial statements. Now, it's time for the employers to implement GASB 68. Most states will be implementing the new standard in their June 30, 2015 financial statements, and obviously there's not much time left for the financial statement preparer and the independent auditor to prepare for GASB 68. Today's webinar will address the key provisions of GASB 68 that financial statement preparers should review one final time, including key issues seen by GASB. Also covered will be matters on which GASB is receiving frequently asked questions. Today we'll also address various audit issues, including approaches that are being implemented by two states with different scenarios. First, you'll learn about the audit approach being used by a state audit office that audits both the pension plan as well as the plan participants. Next, we'll hear from a state auditor that audits the plan participants but does not audit the pension plan itself. Both states will explain how they plan on auditing GASB 68 under these different scenarios while achieving their overall audit objectives. We're really fortunate to have with us today David Bean, who is pinch hitting for Michelle Sirkowski today. David, of course, is the Director of Research and Technical Activities for the Governmental Accounting Standards Board of GASB. Also with us, Jerry Bowes, Technical Manager, Tennessee Department of Audit, and Donna Miller, Director of Professional Practice, Office of the Arizona Auditor General's Office. More information on our speakers can be found in their complete bios, which were provided to you in advance of today's webinar. Now, following their presentations, we will have approximately 25 minutes for live questions and answers. Today, as usual, we are allowing participants to receive audio through either their computer or their phone. And to ask your question, please use the raise your hand function of our webinar software. Simply click on the hand icon that's located in the toolbar. Remember, if you are using a computer to ask your question today, your computer must have a microphone for that process to work properly. Now, if you prefer, you can go ahead and type your question and send it to us at any time during the presentation by using the Questions tab located in the webinar toolbar on the right-hand side of your screen. And again, you can send those questions in at any point during today's webinar. Our speakers will be using PowerPoint presentations, which you should be able to see on your screen now, and they were also provided to you in advance. If you're experiencing any technical difficulties, please give us a call. Our number here is 859-276-1147. Again, that's 859-276-1147. Just one final announcement before we get started. In order for NASAC to be approved by the National State Boards of Accountancy as a group internet-based provider of continuing professional education credits, we have implemented some attendance monitoring tools for individuals. Now, this applies only to those 59 of you today that are going solo, participating in the event by yourself and requesting CPE. In order for us to verify your attendance, you will need to reply to periodic requests that will be sent to the chat toolbar. Watch for these periodic prompts and make sure that you respond. Your response will provide us with a record of your attendance and therefore meet the requirements of NASBA. This is a new method that we've been using the last couple of times. We think it's a better method because it allows us not to have to disrupt the presentation with an attendance check. Those of you participating as groups, you do not need to comply with these prompts. Your attendance will be confirmed by your room monitor. Again, for individuals, we'll be testing your attendance later in the webinar, and obviously these internal controls allow us to comply with NASBA rules for granting continuing professional education credits. We have a very full agenda today, a very timely topic, obviously. I want to express my gratitude to all three speakers for taking time from their very busy schedules to be with us today. And with that, as a very brief background, let me turn the program now over to David Bean. David, welcome to today's webinar.
Kenny, thank you for having me here today. And again, certainly Michelle sends her apologies for not being able to join the group. But we do have a lot to cover this afternoon, or I guess for those of you on the West Coast, still this morning. But what I'd like to do is focus today on 5 hot button issues. The first, and seems like an issue that keeps cropping up time and time again, is questions about the timing of measurement and the effects of the timing of measurement has on the financial statements. Then would like to spend a few minutes talking about the actual measurement calculation itself. Then move on to allocation issues, particularly between component units and funds. Move on to special funding situations, then conclude my portion of the presentation with a discussion of communication issues, because we've got a big hill to climb here, but once the financial statements are out, that's where some would say the fun begins. And of course, I've got a rather strange definition of fun. But jumping into the actual issues, the measurement date. When what should be the appropriate measurement date? The board, I can tell you from a theoretical standpoint, there is only one theoretically sound measurement date, and that is of the fiscal year of the employer. But the board has been very concerned about the timeliness of financial statements. And with governments, especially those who are in multi-employer situations, be it a cost-sharing plan or an agent plan, there were concerns that by the time information was calculated and then distributed to employers for inclusion in financial statements and then subject to audit, the issues that are going to be discussed later in this seminar, that the reports, which some would say are already not timely, would become even less so. So what the board did, of course, in 68 was allow a measurement date no later than the end of the prior fiscal year. And certainly that does provide some challenges. The first, of course, is that if the liability, and that is the total pension liabilities being calculated as of a period other than the fiscal year end, the plan net position also has to be calculated as of that date. So we're actually measuring apples against apples. The other thing that comes into play is the actuarial valuation date. Again, the board provided some flexibility there as far as the actuarial valuation date can be up to 30 months prior to the fiscal year end. We have heard of situations where some believe that 30 months still isn't even enough. That was a topic that was hotly debated by the board before 68 was issued. So, when people talk about, well, could there be any relief? Could there be an acceptable period beyond that? The board has deliberated that issue. Learned in this business never to say never, but the chances of that date moving, hate to be a betting person, but the chances of that moving is very, very remote. But you never know. But anyway, the board again carried over the provisions from the old pension standard as far as actual evaluation of at least every 2 years. Although I think what we have seen based on practice for state governments is that occurs, at least on an annual basis. But whatever the measurement date is, that should be well coordinated with the plan. I'm hoping for those of you who are listening, again, we feel somewhat like we're preaching to the choir. Those of you who are making the effort to check in to see if things have changed, to kind of make that last-minute check, you probably have been coordinating with your pension plan, but you want to make very certain about what that date is. And just to give you an example here, of course, the vast majority of the states have a June 30th year end, recognizing that some have August, some have September, some have even March year ends. But given the fact that most have a June 30th year end, we wanted to use this as an example. But the evaluation based on that should be performed no earlier than December 31st, 2012. If you don't have a valuation, at least for that period, using the new Statement 67 standards from the plan standpoint, pick up the phone, call your actuaries today. And of course, what that date provided was at least a 6-month lag between when the actual standard was improved to that December 31st date. Again, as I mentioned before, the measurement should be no earlier than 1 year prior to the fiscal year end. So in our situation here with the June 30th year end, that's a June 30th, 2014 date. Now that is your ending balance if you choose to have a measurement date other than June 30th, 2015. Now we've seen situations where they'll pick a measurement date as of December 31st or March 31st, but many that we've talked to have been, if they're using something other than June 30th, they have been selecting, or June 30th, 2015, they have been selecting the 14 date. And normally if someone has a valuation before then, what they do is they roll forward that evaluation, so you can have a June 30th, 2013 valuation. It's rolled forward to 14, and that's used for the calculations included in the financial statements. One of the things that have been lost on a few people, because everybody's focused on year-end numbers, please remember, of course, is that when you apply Statement 68, you have to restate opening balances. And to do that, you would have to have a measurement date no earlier than June 30th, 2013. So if your year-end balances are based on 14 dates, then your opening balance adjustment has to be based on a measurement as of June 30th, 2013. And you're saying, okay, I've got 14 numbers. What do I do? How do I get numbers for 13? Well, there are rollback provisions that are talked about in the implementation guide that can be used during the transition period. Now, last year, many of you coexisted data from Statement 67 from the plan side with Statement 27. At least things will be more in sync this year with Statement 68 being implemented. We won't have different assumptions and the like, but one of the things that we get asked quite often is, okay, I pick a measurement date. I pick, this year I'm going to measure as of June 30th, 2014 for my ending balances. Can I change that in the future? And the answer hopefully is not very often, but it's not choose now and forever hold your peace, but it's like any other change in accounting principle. It has to be changed to a preferable practice. So I think you could certainly make that argument moving to the fiscal year end rather than having data be a year in arrears would be preferable. The only situation where you may have some ongoing discussions between auditor and the preparer is that if you use the year-end date and then try to move the measurement period back 1 year. But again, that's not a decision that GASB makes. That's a decision that's made between the preparer of the financial statements and the auditor. Moving on to measurement issues. Discounting has been front and center, been highly debated. It's still based on a long-term expected rate of return. The plans have gone through a calculation to determine whether there should be, whether there's a crossover from a long-term rate to a rate that is based on a 20-year tax-exempt general obligation bond index or yield, and so that has been made. And the reason I'm bringing this up today is that there's still a lot of confusion, a lot of debate on what's the appropriate discount rate. Again, for many plans, it will be the long-term expected rate of return. However, people should keep in mind, and this is often lost in the conversation, that plan assets, when we're looking at that rate, they should be invested using a strategy expected to achieve that return. It's a long-term expected rate of return, not a long-term wishful rate of return. And so that's probably the key to the whole calculation. There have been questions raised as far as, okay, if I've got a significantly underfunded plan, won't I automatically hit the crossover rate? And a lot of it will depend on the projected cash flows from contributions. Many plans have looked at their situation, said, we need to make changes to our contribution rates. Again, that's a policy decision of the government, not one that is established by GASB. But if they set into statute, we're going to have a new rate. Well, we've taken the position, it's what we call the Ronald Reagan approach here. It's the trust but verify. In other words, you're not only going to look at what the statute or the contract or the policy says, but you're also going to consider the 5-year history. Is it effectively do we have a serial underfunder here? A government that promises one thing and then when it comes budget time, deliver something else, or is it something where they have actually stuck to the guns and have met their policy? Now, if there isn't a statute or contract or policy in place, of course, then you would look at the 5-year history to see how they've met their actuarially determined contributions. If you happen to be in a situation where you do hit a crossover, we've been asked, okay, say to use a 20-year rate, based on AA or higher securities or municipal bonds, is there a particular index we should use? We get that question all the time, and the GASB has gone on record time and time again that we don't endorse any specific index. So again, as long as it's an acceptable rate from a preparer and an auditor standpoint, it certainly meets the GASB standard. But the issue of what is the most appropriate discount rate, again, was highly debated all through the deliberations that led up to Statement 68, and that debate is ongoing. Moving on to some allocation issues, and this is where the rubber hits the road for a lot of people right now with implementation. Those of you who are involved in cost-sharing plans, and a number of states are in cost-sharing plans, you recognize your proportion, based on the collective liability, expense, deferred inflows, and deferred outflows. And that's a basis that is consistent with contributions. In other words, how are we contributing? That's normally how the calculation is determined. Again, if there's separate rates, that should be taken into consideration. Now, we also encourage people to use a rate that's in relation to the long-term projected contribution effort. Unfortunately, I think what we're seeing in practice is this is probably, bullet is probably fall into the same category as the NCGA Statement 1 provision that encouraged governments to capitalize infrastructure. For those of you who lived through that process know that probably about 5% of the governments actually capitalize their infrastructure before Statement 34. And even though we encourage a view from a long-term projected contribution effort, what we're seeing as practice is that most people are using current contribution rates, and they're using that to determine their proportionate share of the collective measure. Another thing that we're hearing back through practice is, okay, we give the government, the employer, a proportional share of the net pension liability, the expense, the deferred inflows, the deferred outflows. But as you know, with Statement 68, there's some additional calculations for cost-sharing employers. For example, if there's a change in proportion, if a state government goes from contributing 33% to 34% of the total, that amount, if material, should be recorded as a deferred outflow if it's an increase, and then recognized over the remaining service lives of all of the employees. It's the same way if you have a difference between the proportional share of all employer contributions to the contributions recognized by the employer in the measurement period. Again, so we're comparing what the expense is versus effectively what the contributions were. The difference between those two to make the debits and credits work can be either deferred inflow or deferred outflow. Again, that item should be recognized into expense on a systematic and rational basis over a closed period, and it's, making that very clear. These are not rolling averages, but it's a closed period based on the expected remaining service lives. And then finally, if you do choose to have a measurement date other than the fiscal year end, the contributions that are made between the measurement date and the fiscal year end should be reported as deferred outflows of resources versus expenses. In other words, it can't be used to reduce the liability at all. So it has to be reported as a deferral. Now that deferral is going to unwind the next year, and a new deferral is going to be reported. But again, that's something that has been somewhat lost in translation by some of the early adopters. They think, well, okay, I've got cash flowing out, I just reduced the liability, but the liability was actually calculated as of the beginning of the year, so contributions made during the year was actually like it occurs after the fiscal year end. It's a subsequent event from that standpoint. So that's something to keep in the back of your mind. And these are calculations, particularly number 3, and in most cases for 1 and 2, these are calculations that are not going to be performed by the pension plan. In other words, you'll get the raw data, and then more than likely as a preparer of the financial statements, you will have to go through and make these 3 separate calculations if you're involved in a cost-sharing plan. So keep that in mind. It may not be a situation where you just drop all the numbers in from the plan and you're done. The other thing, again, I want to emphasize is it may not be a one-size-fits-all as far as the calculation, particularly for component units. Remember the paragraph 49 provision, which, and we see this sometimes with college and universities where they have worked out a separate deal. And so their total liability may not be based on strictly on the contributions they make during the year. In some cases it may be below, greater. In some cases it may be less. So please keep paragraph 49 in mind as you're making the calculations as far as who's gets a proportional share of that overall liability. Speaking of calculations, let's get into. I apologize for this. I got flipped here. Let's get into a situation of component units. How do we make allocations to component units? First of all, pension expense should always be allocated to component units. Now, if they don't contribute to the plan, well, what they have is a special funding situation. Effectively, the primary government is legally obligated for the liability, and what the university would report is an allocation of pension expense based on the cost-sharing principles and an offsetting revenue or an equal amount of revenue. This is similar to what we've seen for years with Statement 34. And for the on-behalf payments, well, this is considered a special funding situation under Statement 68. That guidance has been pulled out of 24, and you'll rely on the Statement 68 guidance. Now, if it's not a special funding situation, again, there will be an allocation based on a proportional share. And please don't forget that separate relationships guidance in paragraph 49 that I just touched upon. Question we get all the time. What do we do with funds? You know, I've got enterprise funds. Do I make an allocation? I have governmental funds. Do I make an allocation? Well, governmental funds, modified accrual accounting, there are special provisions in Statement 68 for modified accrual, so there would not be an allocation of the net pension liability to the funds. Enterprise funds. Different situation. First of all, there's no specific guidance on how it should be allocated, but if the enterprise fund is making contributions related to pensions, well, then you would go to the guidance provided in NCGA Statement 1, Paragraph 4, and this guidance has been around since March of 1979, so the guidance is older than many of you who are on the line today. And, you know, this guidance basically says, you know, if you've got a bond note, other long-term liabilities, and one of those examples included way back in NCGA Statement 1 was pensions. If you happen to be making payments that are directly related to and expected to be paid from that proprietary fund, then a portion of that liability should be allocated to that fund. So how do I make the allocation? Again, no specific guidance, but what we've seen in practice is that that many governments are using the guidance related to cost-sharing plans. In other words, they allocate a proportional share to the enterprise fund. However, again, there is flexibility because there isn't any GASB specific guidance. Let's spend I guess the one thing last thing I should point out on funds though is that there is no special funding situation for funds. Again, funds aren't intended to be cost centers, so there's no full allocation of cost. Again, it's only in situations where it's directly related to and expected to be paid from the proprietary fund that the allocation is made. So again, no special funding situations within the funds themselves for the primary government. Speaking of special funding situations, that's our fourth topic here. What qualifies? Again, many governments have gone through this before, have studied statutes, have even sought opinions from legal counsel to determine whether the state has a special funding situation. Again, if the state's legally responsible and they're required to contribute, for example, a defined percentage of the covered payroll, then they would meet, they would meet the requirements. And that contribution is made, and this is important, it's made directly to the pension plan. Then it would meet the provisions for a special funding situation. Also, if the state's the only entity with an obligation to make contributions directly to the plan, that would be a special funding situation. But if the payments are made to the employer, no matter how the calculations are derived, if the payments are made directly to the employer, that is not a special funding situation. The entire liability, the net pension liability, will be reported by the employer and not a fund or not another entity like the state who's providing resources. Now, during the implementation process, we've heard of cases where the states have tried to introduce legislation where they'll make payments directly to the employers, and this is probably one of the first times we've actually seen employers stand up and fight the legislation because they recognize that if the payments come to them, they have to report the entire liability, but when it goes to the pension plan, they only report their proportion, whereas the state reports a special funding liability. But many of those situations have been worked out, and most of the time we know whether a government has a special funding situation or not. But if you haven't worked that through, and particularly as it relates, to well, with our component units, as far as the calculation there, with other governments, and you see this primarily with like teachers' retirement systems, where the state will make contributions on behalf of the local school districts. Again, trying to sort that out to determine whether the state has any additional responsibilities and liabilities associated with pension funds that may not be a part of the plan that they're directly involved in. In other words, the state may have no employees in a teacher's retirement system, but they may have a special funding situation. We also see it in situations where the state's in a cost-sharing plan. They have their proportional share of the liability, but they also have a special funding proportional share of the liability. If that's the case, and you're looking at 68, and you say, can I combine the information? You can combine some of the information, details about the plan or like, but they're two separate liabilities. One is related to net pension liabilities related to your employees, and the other is for a special funding situation. So those liabilities should be separately disclosed in the financial statements. I know that you probably have a lot of questions about calculations and how the liabilities is allocated, but I think one of the items that kind of gets lost in translation is okay, we get to the end, what do we do? We have all this great information, how do we best convey it to our users of the financial statements? And we do have illustrations of notes. We do have illustrations of RSI included in both the Statement 68 in the appendices and also in our implementation guide for Statement 68. But knowing what these numbers mean are so key, because you're going to be getting questions about it. As I mentioned before, discounting is such a big issue. One of the things that is a required note disclosure is a sensitivity analysis of what happens with the net pension liability if the discount rate is 1% higher or 1% lower. And the numbers we've seen coming through the pension plan so far, that sensitivity analysis shows a rather significant swing, especially if you take the current discount rate and decrease it by 1%. And what that is meant to do is for people who say, okay, yeah, that's the expected long-term rate of return, but what if the discount rate was lower? It gives them some feeling and understanding of the effect of that 1% change on the total liability, and they can say, well, what if it's 2 or 3%? Well, the amounts aren't linear, but it does give them a basis for determining what the potential effect could be. The other thing we hear time and time again is, okay, I've got, what happened to the ARC? What happened to the annual required contribution? And, as we've said time and time again with these new pension standards, we are divorcing accounting from funding. And one of the reasons for that is we found that the ARC wasn't faithful or at least not a faithful representation in some circumstances. And so it has been replaced. The focus is on the changes in the liability, so you can compare the contributions made during the year to service cost, or service cost plus interest, or compare it, looking at interest income and seeing are we covering our service cost and interest during the period or not. That is detailed information that was not provided in the financial statements before, and this schedule for single employers and agent multiple employers provides that detail for the users. Another thing is, of course, we are going to be developing long-term trend information. When somebody says that the ratio of plan net position to total pension liability is 75%, well, is that good or bad? In this particular example on page 21, maybe not so good. It was 81% the year before. But if it were 70% the year before, it at least tells you what direction the plan is headed. Now, in this particular example, there is details behind the total pension liability, the plan net position, that's not presented, but we have included illustrations of that in page 137 of the implementation guide, or pages 196 and 197, illustration 2 of the actual statement 68 document itself. But as you can see, there's a lot of data here, and the users will have a much better picture of what's going on with the plan than they've ever seen before. On the cost sharing side, the big difference here is, of course, because it is cost sharing, the focus is on the proportional share of the net pension liability, and you can see how the proportion has changed over the years. To replace, in most circumstances, the ARC, we do have RSI that focuses on the ADAC, or the actual determined contribution. It's referred to as actuarially calculated employer contribution in this schedule. And you can see if the employer contributions are keeping up. Instead of the Kardashians, they're keeping up with the ADAC over a 10-year period. The key thing to focus on here is that the covered employee payroll. That is something that somewhat slipped under the radar screen for many governments when they saw this. But this is not the pensionable payroll. This is the payroll for all employees who are covered by the pension plan. In other words, temporary employees aren't included, but it doesn't include all the payroll. So in other words, if you happen to be in a situation where overtime is not pensionable, well, this number would include the overtime. And we did that to provide a consistent basis for a comparison between OPEB and pensions. Now, this number, because you're the employer, this number should not be difficult for the employer to determine. However, we have heard, and particularly loudly recently from pension plans, that it is a difficult number for the pension plans, particularly those who are multiple employer pension plans, to determine. So that may be something that the board looks at in the future. But from an employer standpoint, remember, this is not the old covered payroll amount from Statement 27. This is focused on the total payroll for all covered employees of the plan. The other thing, of course, I've mentioned several times, we do have an implementation guide for Statement 68, which is available on our website. Question and answers covering many of the topics that we touched upon today. If you haven't gotten a copy, I'd encourage you to either purchase a hard copy or to download it from the GASB website. The other thing that we have been doing is developing a lot of plain language materials to help you communicate this information to your users. We have plain language articles, we have fact sheets, and we also have 14 white papers that were developed by our Pension Communication Resource Group. And NASAC was a member of that resource group, and Kenny and his team participated in that and provided the group with a lot of valuable feedback during the process. And we hope you find this information to be of value to you. So that's a very brief overview. What I'd like to do now is turn things over to Jerry Bowes to discuss the auditing issues related with the new employer pension standards. Thank you.
David, this is Kenny. Thank you so much. And while Jerry gets queued up there, just as a reminder, some of you are already sending in questions, but if you want to send questions in for David, please do so. Again, just type your question, send it to us using the questions tab that's located in the webinar toolbar on the right-hand side of your screen. We already have some that are coming in, and we will bring those out during the Q&A. With that, Jerry, let's turn it over to you. And just as a refresher, Jerry is the technical manager with the Tennessee Division of State Audit. Tennessee auditor audits the pension plan as well as the employer, so they audit both sides. So, Jerry, take it away.
All right, thank you, Kenny. Appreciate the invite to speak to the group, and thank you, David, for the smooth transition. Yeah, as Kenny mentioned, in Tennessee, the Department of Audit, in particular Division of State Audit, we audit the plan, and we also audit all the employers either through our office or through local government audit and contract auditors that audit some of the local governments as well. So with that, I will first start with just a few things that I want to talk to you about today. Give you a little bit of description and background and context to the plans that we do audit. So there'll be the type of plans, the number of employers, and so just some of the context that'll be necessary to see what we are doing, what our role in the office is as we audit the plans and the employers, and then go into a little more depth as to what exactly it was that we did in trying to prepare for not only implementation on Department of Treasury side and Department of Finance Administration, but also as we were implementing the white papers, the AICPA white papers, in auditing the information. So I'll start with first, what we have are two plans that we audit. One's an agent plan and one is a cost sharing plan. They are part of one system in our Tennessee Consolidated Retirement System, or better known as TCRS. And so within that, they are defined benefit plans. And as of June 30, 2014, when obviously Statement 67 was implemented, we had the two plans. But legislation changed after that, effective July 1, 2014, that added hybrid plans. And the hybrid plans basically are a combination of the defined benefit plan and a defined contribution plan. So for 2015, when the plan has its actuarial valuation, we'll end up having 4 different plans, all part of TCRS. So for right now, we have within the agent plan the state as a whole, including its component units, which would include higher education, so our colleges, universities, and then all of our political subdivisions, which are our local governments, which are counties and municipalities. For our cost sharing, that would be all of our local education agencies that cover our teachers. The one good thing about the situation that we have with the plan document is the fact that the plan document is established in state statute. Part of that as well is the fact that state statute defines what is covered employee payroll or pensionable payroll. So it allows us, for where there have been issues related to covered payroll, covered employee payroll, pensionable payroll, and then contrasting that with total payroll, we have a good sense as to what that amount should be. And in this case, TCRS is administered by our Treasury Department. So to give you a little bit of a sense of what the demographics of TCRS is, we have in total membership for both active and inactive, which would include also retired members, we have over 351,000 members that will get some type of TCRS benefit. Continuing as far as what's included within the agent plan, as I mentioned, of course, the state and its component units are considered to be one entity, so one employer. So they are included, as well as the other entities that we have here as well, mainly cities and counties, but others as well. And with this, as being part of what is defined as an agent plan, they do have separate accounting and actuarial records that are maintained for each of these participating employers, which is a key component going forward for us, especially as it's going to relate to auditing the census data. And in total, actually, what we're talking about is more than 627 participating employers that we'll have to consider when we're doing the census data test work. Next, to kind of give you a sense as to some of the changes that are occurring because of 67 and 68 is one of the big things as it relates to the value of the assets. If we're basing the value of the assets on the actuarial value, you can see as far as the unfunded liabilities go, we have $2.6 billion with a funded ratio overall of 93.6%. But if we base that on the market value of the assets per the change in the standard, that amount then goes up to $4.3 billion in unfunded liabilities, with the ratio of the funded status going down to less than 90%. So there is somewhat of a change there. As far as the actuarial assumptions, pretty much going to be the same going forward as we've had in the past, although there are going to be some changes that are going to occur as a result of the 2012 experience study that was done to ensure that the check was projected versus what is the actual experience that was occurring in those assumptions that were made at the time. And so there are going to be a few changes made based on that, and the next experience study will be next year, June 30, 2016. As far as the actuarial valuation, the good thing for us, as David had pointed out in his presentation about the measurement date, for us, the measurement date and the actuarial valuation date for the plan as it implemented 67 was the same as of June 30, 2014. As it relates to 2015 and implementing 68, the actuarial valuation this time is going to not only incorporate the accounting focus, but also in determining the actuarially determined contribution rate. But going forward, there will only be the one actuarial valuation that will be done for both accounting and funding purposes. And as far as the actuarial data that Treasury maintains as basically the record keeper of the census data is going to incorporate the census data for the active members, the inactive members, which also includes retired. It's going to include the asset data or the fiduciary net position and the benefit terms and conditions. And what we're finding out is, as the AICPA white papers indicate, for us, even if in the for the participating employers, the key point is the fact that even if they wanted to calculate the information of the pension amounts to include in their financial information that's required by the standards, they wouldn't be able to do so. They will actually maintain the active member census data, but they have no access to the other information for the inactives and the retired members. So this is an extremely important point that for the participating employers, they're going to need to, on an annual basis, obtain that information from the administrator of the pension plan, in this case for us, Treasury, simply for the fact that since they are responsible for their own financial statements and their own financial reporting, they need to be able to look at the data to ensure that it is accurate and complete. So here's the funding policy going forward. You'll notice that as the change was made in the standard to go from 6 actuarial methods down to 1, you'll see that that's consistent with what Treasury is intending to do with the entry age normal method. As far as the plans themselves, as you can see here, we're talking about as far as the cost sharing plan, the local education agencies, there's 142 of those. And that's going to be key as to what we did with the cost sharing as it relates to the plan that was included in the recommendation of the AICPA white papers. And I'll get to that in a few minutes. Just to kind of focus on what the standard requires as it relates to what's going to be presented and disclosed. This is what TCRS will look like as it presents the information related to both plans, the agent plan and the cost sharing. And as you can see, we have a net position that is $42.9 billion in total. And the key part of this is going to be the fact that we end up actually with a net pension asset. When we take into consideration all the changes here and the different components that the standard requires, the total pension liability will be $21.1 billion as actuarially determined, which was based on the July 1, 2013 actuarial valuation that was rolled forward. And so here's an example of the LEAs, or the teachers, in the cost sharing plan. And it, as I indicated, does have a net pension asset that will be recognized and presented on the face of the financial statements. So with a funded ratio of over 100%. There's only a few plans in the nation that actually end up with a net pension asset, and so that is certainly a positive and much easier to actually communicate to those that are charged with governance that you actually have an asset as opposed to a huge liability. Some additional information that is required to be presented is related to the analysis, and as you can see, the discount rate and the long-term expected rate of return is very material to not only the financial statements but in the calculations of the assumptions. And you can see just 1% decrease in the discount rate has a major impact on turning that net pension asset into a huge net pension liability. Just some more information that's being required as far as the RSI. This is what it would look like for TCRS. So I'll just fast forward through all that, and so I can get to the main points, which are what this all means for us as far as an audit perspective. Well, this has a huge impact on our local governments, because for the first time our local governments as participating employers in the plan are actually going to have this liability and the other pension amounts that will be presented on the face of the financial statements. They've never had this before. All they were concerned about before was, okay, we made the required contribution, and at least in Tennessee, they are required by law to contribute 100% of the required contribution rate. And if they fail to do so, then actually state-shared taxes can be actually withheld to ensure that the contributions are made. So at all times, 100% of the contribution will be made, and there should be no deficiencies in what's required and what's actually contributed. So from that standpoint, it was easy in the past prior to 67 and 68, because the local government simply found out, okay, this is what we contribute, this is our expense, we're done. That's no longer the case. They actually will have to present a liability. So the biggest question is, where do they get the information? And as I said before, well, if they wanted to actually do the calculations and present the information themselves, they could not do so because they don't have access to all the data. And so what is really driving these pension amounts is the underlying census data. It is extremely material to the calculations. It is the driving force that ends up on the financial statements. And so from an audit perspective, we wanted to make sure that at least in year one, we basically didn't screw anything up. Because if we get it wrong in year one, then we have a problem going forward. And so we reviewed very closely the AICPA white paper recommendations and found those to be very reasonable, and decided that basically we were going to follow them as a whole. And so there really was very little difference in what the white papers indicated and what we actually did. So from the standpoint of doing the census data test work, at the state level in auditing the plan, we pulled samples of the inactive employee, well, the inactives that were in the plan, and tested for accuracy of the information and completeness. And so it essentially ended up being a top-down and a bottom-up approach. We performed that test work at the pension level and on the inactives, and our local government auditors, and also in conjunction with CPA firms auditing the municipalities and 5 of the county governments, audited the active employees in the field and pulled samples of the information and verified what they found there to what was actually sent to Treasury, that Treasury then collected and sent to the actuary. And so we went both ways, from the ground, where we pulled the sample of the files that were at the actual employer, versus what was at the plan and what the actuary had. And so with that, we ended up performing both accuracy test and completeness tests, because we certainly want to make sure that, because this is material information that's driving the pension amounts, we wanted to make sure that from our standpoint, we did obtain sufficient appropriate audit evidence related to these census data elements. And so I'll wrap up here shortly with basically what ends up happening. There was a big question early on about whether or not there would be modified opinions on the information, especially if we could not audit the census data of the participating employers. What we have found out is that so far it has been, I hope I'm not simplifying this, but fairly easy to be able to audit the census data at the employers. And so therefore we really didn't have to worry about ending up modifying any opinions. So we ended up with certainly having some deficiencies in exceptions that we found in the test work that we did, but nothing that was cross-cutting and that rose to the level or the threshold of it being a material weakness. So our approach was very simple: follow the white paper guidance. We thought that was certainly sufficient for us to be able to do, and turned out to be a pretty good thing. So from the standpoint of our cost-sharing employers, one of the things that we did as what was recommended in the guidance was to determine if we had any what we call Tier 1 employers that represented more than 20% of the contributions of all employers that participated as cost-sharing employers. And in this case, we really had none of the 4 Tier 1 employers that even came close to that. So when we audited our Tier 1 employers, we chose a sample that was, we thought, sufficient enough to be able to get us the sufficient appropriate audit evidence we needed to opine. And that's what we ended up doing, was opining on the plan as usual, and also on the schedules. So the schedules that would be to show the information by the employer, we opined on each of the columns, each of the main columns, so that the employers and the employer auditors would be able to utilize that information so they would have sufficient appropriate audit evidence for them to opine on those individual employer financial statements. And then at the plan level, that was part of the attestation engagement. That was one of the options in the white paper. When we got down to the Tier 2 employers, just the top 10, when we add them all up, would give us over 57% coverage. And when we get to the Tier 2 employers, we would audit those on a rotation cycle every 5 years, and then the Tier 3 would end up being over a 10-year cycle. And then all those that were less than 2% in the aggregate, we would not audit at all. So just in wrapping up as a summary of the different work papers and where the information was obtained as it relates to local government and state audit, for the agent employers, the actuarial certification letter from the actuary obviously would come from the actuary. The actuarial valuation report as of the measurement date would also come from the actuary, and the problem we were having right now is that the actuarial report we don't have yet. We anticipate getting that in June next month, so hopefully once that is done we'll be able to continue to finish the work on that information. The notes to the financial statements, luckily for the local government, well, for the participating employers, lucky for them that Treasury is going to be providing them with a template of all the note disclosures, all the journal entries, and what's supposed to be included for each employer, what's supposed to be included in their financial statements. So it's going to be pretty easy for the participating employers, although I will caution on that note that the employers and management of the participating employers are responsible for their own information. They will be making management representations to the employer auditor. And because of that, they need to ensure that the information that they're getting from Treasury is going to be complete and accurate. And that means, at a minimum, reading through the actuary's report and the data file to ensure that the information that is presented is accurate and complete. The amortization schedules for deferred outflows and inflows will come from Treasury. The examination, engagement, opinion related to the census data for the inactives and retired TCRS members will come from our office and state audit. The census data, that'll come from Treasury. The sample of the census data for accuracy and completeness, our local government auditors will do that. In this case, we did not use a specialist. Obviously, management has a specialist for the plan audit, for the plan management. They're using an actuary, so the work that we did on what the standard requires us to do with management specialists, local government auditors are getting that from us. The work paper that demonstrates actuarial data agrees with the data in the Concord system, and this is the system that the participating employers input all of the census data into, so that when Treasury aggregates that, that's the data file that goes to the actuary. That will come from us as well. Journal entries, again, from Treasury. Contributions between the measurement date and the report date, that will come from the local government auditors. The calculation of allocations to component units, funds, and departments. LGA will be doing that at the local government level. At the state level, it's tentatively decided that Finance Administration will actually be performing those allocations, and it will also be based on the same as it is for everything else, and that will be on contributions. The memo regarding employer responsibilities, local government audit has prepared a memo to keep the employers up to date and what they're going to be responsible for. And then as far as the opinion on the schedule of changes in fiduciary position, we in state audit are doing that so that the LGA and CPAs can rely on that information. Other information here as well, you can see, I'll just quickly go through these, where that information is going to come from for the cost sharing plans, the same as cost sharing plan, same as it was for the agent. And as far as the examination engagement, again, that would come from us in state audit that the employer auditors will be able to rely on. And so with that, I will turn this over to Donna, and we tried to coordinate a little bit so that you could see some of the same things and how Arizona was handling a similar situation, except that they don't audit the plan. So Donna, take it away.
Well, good afternoon, everybody. I'm having technical difficulties. I don't know if you can see my slideshow yet.
Yeah, Donna, we can see it.
You can see it. I
Yeah.
can't. Let me see if I can figure out where it is. All right. All right. Sorry, everybody. Thank you, Jerry and Kenny and David. Your presentations were very interesting, you guys. And hi to everybody else. I am so honored to have been asked to present today. And as Kenny and Jerry mentioned, my presentation is to give you some perspective about a state audit organization that audits participating employers, but that does not audit the plans. And I love the title of this presentation because the question, are you ready? My answer is not yet. We were hoping to be ready by now, and we're struggling with a few things that I'll talk about in a little bit. So my presentation today is going to start with telling you a little bit about our office, then a little bit about Arizona's pension plans, and then what we have done and what we're doing to help with implementation and audits of the pension amounts and disclosures that the participating employers will have to make. My contact information, just so you know, is on the last slide, and if we don't get a question answered today, you're more than welcome to contact me at a later date. Is my next slide up, by the way?
Donna, what I see is like a Word file.
Okay, I've got the wrong screen showing.
Yeah.
Oh, you've got my talking points. Everybody can just read them. Okay, let me see what's going on here. Obviously, I've never done one of these before, so everybody knows. Okay, I don't know why, but it's opening on the wrong screen, and I'm not sure how to make it open on the right screen.
If you go down and go down to the bottom, can you click on that from the beginning, Donna?
I did, and it keeps pulling up on the wrong screen, so I don't know if I can start the presentation to come up on another screen.
Can you grab the top and pull it over?
Yeah, see, I'm pulling it over here. Can you see it?
There you go. Now just click from the beginning, and it should go to slideshow mode, I think.
Well, I did, and then it's popping up on another monitor that I have, and I don't know how to make it pop up on this monitor. Let me try starting it over here and see if it'll start. Sorry, everybody. It worked before. No, it keeps starting up on my main monitor. All right. Can you send me the link again, Anna? Let me see.
That looks good, Donna.
Okay, well, let me see then. I don't have mine up. So okay, can you see it now?
No.
Now you're not seeing it?
No.
Now I'm seeing it. All right. Hold on. Wait, I almost had it.
Now I can see it.
Now you can see it. Can you see that now, the second slide?
No.
This is Anna. I'm showing my screen right now. Donna, do you want to do it that way, or do you want me to give you controls and let you try it one more time if you hit show my screen clean?
If I can control it from your screen, then that's fine. Let me see. Yeah, this should work now. Okay, can you see me controlling that now?
We can, yes.
Okay. Gosh, I'm so sorry, everybody. Now I'm doubly nervous, so everybody stick with me. So I'm going to start by telling you a little bit about our office. We're a legislative audit agency, and we conduct both financial and performance audits. As far as our financial audit responsibilities are concerned, we audit many of the participating employers, but not all. These include the state of Arizona's financial and federal compliance audits, which includes our 3 state universities. And we're also responsible for the financial and federal compliance audits of our 15 counties and 10 community college districts. And our responsibilities for those include providing reporting guidance. Unfortunately, CPA firms conduct the audits of all the other participating employers, including our state's municipalities, school districts, charter schools, and tribal governments. And we have no jurisdiction over those audits, except that we do have some responsibilities over school districts, including providing some reporting guidance to them. And regarding our pension plans, in Arizona we have 6 statewide defined benefit pension plans, 3 cost-sharing multiple employer plans, and 2 agent multiple employer plans, as you see here. And these plans meet the criteria to be reported as legally separate, discretely presented component units of our state. And I thought it would be good to share at least some information about these plans so you know what we have had to think about in our implementation planning. So here you see a list of the plans by type. The cost-sharing plans include the Arizona State Retirement System, commonly referred to by everyone as ASRS. It is our state's main pension plan with over 600 employers and 540,000 active, inactive, and retired members. Next is our elected officials retirement plan, and it has only 2,045 total members. This defined benefit cost-sharing plan has been closed to new members, and a defined contribution plan was started in its place for newly elected officials. Our state has been statutorily committed to contribute directly to the plan, $5 million a year for 30 years as a non-employer contributing entity. So therefore, this plan has a special funding situation that David talked about earlier. Next is the Correction Officers Retirement Plan, Administrative Office of the Courts. And this is a very interesting plan because it is actually part of the Agent Multiple Employer Plan that is listed below. But because it includes 15 separate legal entities that share the assets and pension obligations, it is actually considered a separate cost-sharing plan and is reported in a separate column in the Corp's basic financial statements. Next, you see our Agent Multiple Employer Plans. First, the Public Safety Personnel System, PSPRS, as it's called, is our state's plan that provides pension benefits to our police and sheriff departments, as well as our firefighters of our counties and municipalities, as well as those at our universities and some tribal governments. This plan includes about 250 separate participating employers with over 32,000 total members. And last, our Corrections Officers Retirement Plans, which is relatively small, with only about 25 participating employers and just over 20,000 total members. And I should note that all of the plans other than the ASRS are managed by one system called the PSPRS, the same name as the pension plan name. Therefore, our office has been coordinating with the 2 pension systems, one over ASRS and one management group over all the other pension plans that are managed by PSPRS. Unfortunately, the systems each have different CPA firms and different actuaries that we've been having to work with. And the ASRS and PSPRS plan are relatively large, that's why they're bolded here, compared to all the other plans. So I'll focus most of the rest of my discussion on only these 2 plans. And just to give you a few extra details about them, here you see more information about ASRS, and as you can see, its net pension liability at June 30, 2014 was $14.8 billion, and the total pension liability was 69.49% funded following GASB's requirements. Also, you see PSPRS summarized, as everyone knows, as an agent multiple employer plan. These 255 individual employers each have separate net pension liabilities and funded statuses. And the slide shows that in total, when we sum all the employers together, this pension plan had an estimated $6.3 billion net pension liability, and the average funded status is 48.52%. And what is most interesting about this is that the range in these employers' individual funded statuses is about -7% to over 370% funded, which is a very wide difference that varies between these different employers. About 40 employers actually are estimated to have net pension assets, one with more than $4.7 million in net assets. And many of the more unfunded employers have contribution rates that are above 60% of members' salaries. So this is an interesting slide that I like to share. because as you can see from these two middle columns here, it shows, and if you look at the column titles, it shows the difference between the net pension liability calculated using GASB's methodology versus ASRS's funding methodology. And you see that the net pension liability is much higher using GASB's methodology. But it's not for the same reason that Jerry explained. His plans are different from the methodologies. If you look at the total pension liability, or what was formerly known as the actuarial accrued liability, you see that it's $7 billion higher under GASB's methodology. And if you look down here and see, you can see what some of the differences are. And the plan has explained that the main difference in that calculation is because of the actuarial method. They have always used, or have used for many years now, the projected unit credit method to attribute the discounted obligation to the present years of service. And now they've switched to this entry-age cost method, which caused this total pension liability to go up. It also went up because they have started to factor in the permanent benefit increase here, which is considered substantively automatic under GASB standards, which also made this amount go higher. But the discount rate you see is the same. So that long-term expected rate of return, which appears to be reasonable based on past history, it's not a guess, or it's not based on a big hopeful wish. I think it's based on past experience, as David pointed out, something we need to think about. But if you look, you see that the pension assets are actually higher under GASB's methodology using the fair value at June 30, that fiduciary net position balance is higher than when they smooth the assets over the 10-year period. But that didn't make up enough to make the net pension liability be lower under GASB's methodology. So I just think that's an interesting thing that came out, and I've been working for an audit office for over 20 years, so I find weird things interesting. So anyway, moving on. As you can see here, this shows by membership the top 10 employers in the ASRS. As you can see, we don't audit some of these. We don't audit the school districts, but we audit a lot of these large dollars. Everybody below this is about 2% of the plan. This is based on ASRS membership here, because the plan has asked us not to share these contribution or these proportional shares based on required contributions as of yet. They're still working on that schedule, and I'll talk about that more later. All right, so here's some background information on PSPRS and the governments that it includes. And I should mention here that we don't yet have GASB's methodology calculations for our agent multiple employer plans. I've estimated these amounts taking into account each employer's fiduciary net position deducted from the actuarial accrued liability for funding purposes. And I feel fairly confident that these amounts are close. But for PSPRS, here you can see that although our office does not audit the municipalities, which is 125 of the entities, we are responsible to audit most of the other employers. And we also knew that in our state, because municipalities are audited by CPA firms and there really isn't a central coordinating audit group or standard implementation body, we knew that in order for every entity to have a smooth implementation, we as an office needed to help coordinate. We felt we had a large stake in responsibility. Therefore, we began coordinating with the two pension plans almost 3 years ago to help coordinate efforts. We've been sharing as much information as possible and have even given presentations together at conferences. And we felt it is important to present a coordinated effort, consistently providing the same message to all participating employers. And once the ASCPA's white papers were issued, we decided as a group that we would follow them the best we possibly could, given how we interpreted them. And lastly, we decided that we would guide every employer to use a pension measurement date that is a year behind the report date. Therefore, our governments, our participating governments, will report pension amounts measured at June 30, 2014 for all plans in their fiscal year 2015 financial reports. And as it turns out, that's a very good decision because all the information that the participating employers need is about 2 months behind schedule so far. So now to get to some specifics by plan type about what's going to be provided. For cost-sharing plans, we decided that these plans would be the easiest to handle. And if you're familiar with the recommendations in the ASCPA's white papers, there were options for how the cost-sharing plan auditors could gain evidence over active member census data, where the evidence for that census data was at the employer government and not with the pension plans. So in meeting with each systems management and their auditors, we all agreed that it would be the most efficient approach in our state for the system auditors to audit all the member census data, even if that meant having to gather evidence from many individual employers. This, of course, required the systems to facilitate cooperation from the sampled employers to get the needed support. And fortunately, they found that in most cases it was very easy to get cooperation, especially when they explained the process and why it was needed and the more timely alternatives. Next, there was the matter of determining what the plan would use to determine each employer's proportionate share of the pension amounts. Several large employers wanted some say in this because they were worried that they might be allocated an unfair proportion. After several meetings and discussions between the two systems and our office, as well as those concerned employers, we determined and agreed that using actual required contributions would be the most accurate and efficient approach. Using any future projected contributions that GASB recommended would have made the proportions much more difficult to audit, and in the systems analyses, it was determined that it would not have made a huge difference in the proportionate shares. And each of the cost-sharing plans will be providing a schedule of pension amounts by employer. But I need to tell you that unfortunately none of the state's cost-sharing plans have issued their allocation schedules yet. They were all supposed to be done by now. So we're patiently waiting and happy that they want them to be correct at least and not just send out something that was wrong. So there are a few factors that we know are holding the schedules up, which I'll explain in a minute, but for over a year, the systems have been evaluating exactly what information they need to include so that employers and auditors will have what they need and have audit evidence as of it all as well. Some of the elements that ASRS has decided to include are the proportionate shares of beginning net pension liabilities at June 30, 2013, the plus or minus 1% sensitivity calculations proportioned to each employer for their note disclosures, future amortization amounts by year for each deferred inflow or outflow of resources, again for note disclosures. And one thing that has been holding up the schedule is making sure that each employer's allocated amounts balance. They've run into issues because in some cases they've had to annualize some of the employer's contributions, so they're having to build that into the schedules and still make it come out to balance in the end. And then there's been some rounding issues as well. For our agent plans, we have had several different factors to plan for. Again, we follow the guidance in the ASCPA white papers. Unfortunately, for our agent plans, the actuaries have always prepared individual actuarial reports for each employer, so therefore this concept wasn't new to the plan's actuary. However, what we didn't anticipate early on is that the actuary would need to prepare two separate actuarial reports for each of the 255 employers in the case of PSPRS. One was prepared for funding purposes, and it needed to be prepared earlier for budget and compliance with state laws. The actuaries did not have enough time to include separate calculations in those actuarial reports to comply with GASB's methodology. So in the end, what the system management has decided is that it would be beneficial to issue each employer a comprehensive report for implementation purposes. And that comprehensive report is going to include all the information that each employer will need, including its individual statement of changes in fiduciary net position and the auditor's opinion on that statement. If everyone remembers, the ASCPA white papers provided options regarding how individual employers would have evidence that helped ensure the accuracy of each employer's allocation of assets. The options were either a SOC 1 Type 2 report or separate audits of each employer's schedule of changes. Because it was too late in the year when we started the planning, auditors decided to perform the procedures. Auditors couldn't perform the procedures necessary to issue a SOC 1 Type 2 report. So we had many discussions about whether it would even be possible or feasible for the auditors to opine on each individual schedule. And they decided they would give it a try, and they're working on it now. And we're still not certain how costly it will be and whether doing a SOC 1 Type 2 report in the future would be less costly. The auditors aren't sure about that. So if any of you are dealing with agent plans and these individual actuarial reports, one piece of advice that I'd like to pass along is that you ask for drafts of these reports with fictitious amounts if you have to. What we learned in reviewing several draft versions is the actuaries did not understand the depth of the information that employers would need to make adequate note disclosures under GASB 68, especially over elements such as enough detail about actuarial assumptions and methods regarding COLAs, information about the discount rate, including assumptions about projected cash flows, how the long-term expected rate of return was determined, and whether the expected rates of return were presented as arithmetic or geometric means. And we're still struggling to get some of that information. Every draft that we get is either still missing some information, it's included some, but then missing other information. So if you haven't seen those reports, I suggest getting a draft as soon as possible. One final issue we are battling for agent plans is how employers are going to obtain the actuary's active members' census data. We have determined that the plan auditors will issue an attestation report with assertions over the accuracy of census data, including an assertion that addresses that the census data used by the actuary agrees with the census data maintained by the plan for all members. However, the AICPA white paper, as I hope most of you know, recommends that employers and their auditors verify the accuracy of the active member census data that's actually used by the actuary. So we're continuing our communications with management to help determine a way that this confidential and sensitive member data can be shared with the employers, and we're battling with different ways and methods. So that's more to come that you can ask me about later. So the last things that I want to share with you today is about what our office has been doing to help all employers know what specific information they will need to report or disclose that's specific to Arizona's plans. So to that end, as of now, we have developed two separate sets of guidance available on our office's website. The first is a set of reporting guidelines for specific government employers shown here. These guidelines incorporate information from all the applicable pension plans and include a prior period adjustment note and all GASB 68 required note disclosures in RSI. So we've used a lot of GASB's information to do this, and we've compiled the information from each of the pension plans CAFRs and actuarial reports to put this together as a guide for our state's employers. We feel that these will consistently help the employers consistently report the correct information, and the county guidelines, if you open them up on our website, you'll see that they're 35 pages long. So the GASB promised that we'd have more robust pension disclosures, and this is evidence of that. That 35 pages is quite a long read. We've issued these guidelines with some disclaimer information because we want all employers and their auditors to understand that our guidance does not substitute for management's necessary skills, knowledge, and experience. And we've also asked for comments and feedback to help us ensure that we have appropriately addressed GASB's required elements. We haven't gotten any feedback yet, but we're hoping that the guidelines will be helpful. Another set of guidance we provided is actually example journal entries based on fictitious numbers included in a cost-sharing schedule of employer amounts that will be similar to the cost-sharing schedule that our plans will provide. And we thought this would be especially helpful for the more remote governments that we have, and shows how to journalize pension amounts in their year-end adjustments and how to report the prior period adjustment. So I'm running out of time, so I'm not going to talk about any of this in detail. It's here as an illustration. This is our link to our reporting guidelines on our website. This is illustrates the detail we have included, and this detail is organized and included for each plan that could be applicable to a county in this case. Here you'll see the details needed for a cost-sharing plan's pension liability, and I wanted to point out that we have added some information here to include liability disclosure requirements of GASB 34. See that right here. This shows the change in the liability, and in another section I'm not showing here, we have a disclosure where it's suggested that we tell them to disclose what governmental funds have typically been used to pay the liability. Also here you see a bright pink highlight. That indicates we don't yet have that plan information. So this illustrates the deferred outflows inflows disclosure requirement. This blue highlight signifies an amount that the county would have to come up with on their own. This is county contributions subsequent to the measurement date. The plan will not be providing that amount, but they will have to defer, put that in deferred outflows. And anything that's blank on any of our reporting guidelines is an indication that the plan will be providing that information. This shows how an employer might report the discount rate, and this is an illustration of RSI. Again, as David pointed out, this covered employee payroll amount is something that the counties and other participating employers will have to come up with on their own. We've highlighted that in blue. Okay, and finally, these next two slides give an example, show what we've got for our journal entry guidance. This is the fictitious schedule with some other information here, and then we show the journal entries themselves. And again, all of this is available on our website at azauditor.gov if you would like to review any of it in more depth. Finally, I wanted to share what we wish we had more information on by now. But this is the employer audit issues we have been and continue to be thinking about. And this slide covers some of those important elements that are brought up in the AFCPA white papers. I hope most of you are familiar with some of these. We are in the process of developing guidance specific to Arizona, perhaps even some question and answer guidance to help CPA firms in their audits of Arizona's plans participating employers. And that will be soon to come and on our website. And last but not least, in our office, we are currently working on an audit tool for our auditors to use to ensure that we have sufficient audit documentation over our auditees' pension amounts. This tool will cover reliance on the work of the plan auditors and actuaries and guidance over risk assessment, census data auditing, determine the reasonability of the proportionate share calculations, and other note disclosure elements. And I don't know if we're going to share that tool on our website, but again, you can contact me, and I would be happy to share it when it's ready. So thank you, everybody. Thank you for struggling with me through the beginning of getting my slide presentation going. And again, here's my contact information. Feel free to contact me if you have any questions. Thank you so much again for your attention today.
All right. Thank you, Donna and David and Jerry. Outstanding presentation. Let's jump right to Q&A. We do have a lot of questions in the queue, and I'm just going to start right at the top. And David, I think this one's for you. It goes like this. For cost-sharing plans that allocate a negative pension expense to employer participants, is it to be presented as a negative expense on the statement of activities or as a revenue? And if a revenue, should it be general revenue?
Well, first, let me say that there's no specific guidance on this. So as in the opening slide, these are my opinions and not those of the board. So with that as a qualifier, normally what you're going to see in a general purpose government, pension expense is not separately presented in the financial statements. So what that will do is reduce the overall cost of a program. Now, if you happen to present pension expense on the face of the financial statements, you show it, for example, by natural classification, and it's not salaries and benefits. Again, most people report salaries and benefits, and it would just reduce the salaries and benefits. But if it is presented separately, it would be shown as a negative expense. It should not be shown as a revenue.
All right, thanks, David. David, let me stay with you. This question pertains to permanent funds. And the question is a permanent fund whose employees participate in the state pension system required to report pension expense on its separately reported financial statements, and then they parenthetically tell us which are rolled into the CAFR?
The answer would be no, simply because a permanent fund is reported as a governmental fund. And again, GASB does not issue specific standards for departmental reporting or effectively standalone fund reporting where there is not a separate legal entity. But the fact that a permanent fund is a governmental fund. There would not be an allocation to the governmental fund for the primary governance financial statements, and I would just take it from there as far as the individual fund reporting.
All right, let's change gears. Let's take an audit question. Jerry, we'll start with you, and then maybe Donna. The question is, if the cost-sharing plan auditor, the plan auditor, performs the audit procedures related to the census data and appropriately reports on the plan, what additional procedures are expected of the employer auditor, if any? And they also tell us, just to clarify, that plan auditor has not requested that the employer auditor perform any procedures. The plan auditor has completed all the necessary procedures.
I think I can field that question, Jerry, if you want me to. Can everybody hear me? I can't hear you.
Yeah, go ahead, Donna. We couldn't.
Okay.
I didn't hear Jerry.
Oh, yeah, I didn't hear Jerry either. Anyway, that's a very good question. We are looking at it from our perspective because our plan did a very detailed audit of the census data at the employer governments, the census data that's relevant for the net pension liability that will be reported at the June 30, 14 measurement date in the 15 statements, that for cost-sharing plans, our employer auditors don't have really any responsibility to audit that census data. We're waiting for the AICPA to get chapters in their audit guide that maybe disputes that, but from what we can tell from the white papers, that seems to be an okay approach. It does make sense, though, for cost-sharing plan employers to at least make sure that what's being submitted to the plan is accurate. But as of now, we're not planning to have our office audit that census data.
Kenny, can you hear me now?
We can hear you, Jerry.
Okay, I didn't have my mic down, so that was why. I'll add just a couple of other things to what Donna said, and I agree with what she said. The white papers go on to indicate that ultimately it is the employer auditor's responsibility to determine how much sufficient appropriate audit evidence is enough. So in other words, if the plan auditor follows the approach that's in the white paper, the assumption is that that's sufficient enough that the employer auditor can rely on. But ultimately, that employer auditor needs to determine, based on their individual circumstances, whether or not that is enough. At least in Tennessee, we are, as I indicated, we're opining on each of the columns in total for each of the employers that are included on the schedules, and that would also be the same as it relates to the schedule of changes in fiduciary fund net position as well for the agent plan, the agent employers. All 500 of them, we're going to opine on each of the information for each of the employers. So if that approach is followed, that should be sufficient for the employer auditor to rely on.
All right. While we're in this area, let me ask one more question of Jerry and Donna. Question is, how would you recommend that local government auditors, the auditors of local governments in a cost-sharing plan determine if census data issues at the local level are material enough to materially alter the local government's allocation of pension expense liability or assets and deferrals? Any guidance that you could offer there?
You've hit a hot button topic with me, Kenny. That's the big question, isn't it? Is if you run into errors when you're auditing census data, how much is that going to impact that estimated liability that has so many other factors associated with it? And so I think what has to be done is, if you found enough errors that you think it could significantly impact your employer's proportionate share of a cost-sharing liability, you're going to have to go back to the plan and go back to the actuaries and ask them their opinion. I don't know of any other way. But I honestly feel that short of some kind of systematic error that's throwing off, say, everybody's salary amounts or everybody's birth date, I don't know that it could significantly impact that estimated liability. But that's just one person's humble opinion without a lot of knowledge.
Thanks, Donna. Jerry, you have anything else on that?
Yeah, I agree with you, Donna. I think one of the key aspects is going to be talking with the actuary, communicating with the actuary as to which of those census data elements are going to be material, because obviously there are some that would not be material, but the ones such as, payroll, obviously, that's going to be one that's material. And if it turns out that there is some element of that or attribute of the material census data element that is going to be causing an issue, I think Donna's correct. It would have to be system-wide, because in the end we are talking about individual participating employers, and it's going to be difficult for one employer to be material to the system as a whole. Now, it might be material to that individual employer, but you'd also have to see how many employees they have that participate in the plan. If you have a total of 250 employees and you have 200 of them that has a data element that's incorrect, well, that could be a problem. But 250 employees compared to 40,000 in a plan is not going to be material to the plan. So you have to take those into consideration, but I think overall it's going to be difficult for it to pose a problem. And if you do recognize that there are some deficiencies, if those get corrected in year one, then going forward it shouldn't be a problem.
Yeah, I agree, Jerry. And also, I would also like to add that I think the most important thing is to test and understand the controls, especially that at the plan level, for how they gather that census data. That, to me, is the most important thing, is testing those controls, because that's where you could run into those system-wide errors that could be happening.
Thank you, Donna and Jerry. Let me stay with y'all one more time. Another question about census data and plan versus employer auditors. This one is, for my state, the auditor's office audits the state as the employer, and we do not audit the plans. We have 2 cost-sharing plans, and for both cost-sharing plans, the plan's auditors have indicated they will handle all census data testing. Do other states have comparable situations? Should employer auditors always perform at least some census data testing?
Well, that's very similar to the first question you asked of us, and it's the situation in our state. And to answer that question right now, as I said before, we are looking at it as if the plan decides to do a detailed audit of the census data, and we're communicating with them, and we know what they've tested and how much they've tested and what evidence they've looked at. So keep that in mind too. We're not just blindly believing them that they've audited that census data. So in our case, we feel pretty okay that we don't need to also audit the census data of our state and the other participating employers as well. So that's my short answer. I think every situation could be different, so I think it depends on how you feel they've audited that census data in your state.
All right, thanks, Donna. Jerry, anything else, or we covered that pretty adequately, you think?
Just maybe one little piece of information. I think it wouldn't be unlike any other procedures that we would perform, where we get comfortable with the the independence, the objectivity, the experience, and et cetera, of the auditors that are doing that work. And just like in a predecessor auditor relationship, or like internal audit, where we're looking at their competence and all that, we review their peer review reports. If we have done that type of information beyond what Donna was talking about, where they have a knowledge about what that employer auditor has done, or the plan auditor, then I think if you've done those types of things, that could be something else that you'd consider. One thing I wanted to mention that I forgot to in my presentation just very quickly is that in our situation where we're auditing the plan and the employers, we in state audit are the ones who are establishing the audit procedures and the testing plan for the census data. So we're telling LGA what it is we need. They're telling the contract auditors, the CPA firms, what it is, so that they're all performing the same consistent work. But we would have also gone through the same types of procedures where we're getting comfortable with the CPA firms and the work that they do, peer reviews, et cetera. So that all can be a part of it.
All right, David, let me come back to you with an accounting question, preparer question. The question is, could you expand upon your statement that preparers have flexibility in allocating the net pension liability, or the NPL, and pension expense to proprietary funds? Under what situations would the NPL not be allocated? In our specific case, we are considering allocating the NPL to higher education institutions that are departments and classified as business-type activities and assessed a fringe benefit charge, with the allocation based on their fringe benefit, their fringe contributions for pensions as a share to the state's total pension contribution. Is there flexibility in such a situation?
Well, when I talked about flexibility, it's flexibility as far as the actual allocation itself. The board was very clear in referencing, when they referenced paragraph 42 of Statement 1. I mean, if the liability is going to be paid by, and that's always the big question, because you have to look at the language. If it's expected to be paid by the proprietary funds, if it meets that criteria, if it's directly related to, which in the case of pensions it would be, and if it's expected to be paid from the proprietary funds, the liability would be allocated. But that's a choice. That's a choice that the government makes, and that's where I talked about the flexibility. I mean, the government chooses through policy about whether there is going to be an expectation or not. But once there is an expectation, they're required to report it. Now, as far as how it's allocated, again, many governments have chosen to use that cost, cost-sharing plan allocation approach. But there's, again, no specific guidance provided by the board. Will it be provided by the board in the future, through an implementation guide? That's still a topic for debate. But as of the present time, there's no specific guidance on a required allocation method. But so again, it's very facts and circumstances based.
David, let me stay with you. You kind of mentioned future actions by the board. Are there any anticipated changes to the pension standards in the near future? Well,
as many of the people that are participating in this webinar know, that the GASB is on the cusp of issuing some brand new standards related to other post-employment benefits, which will be statements 74 and 75. But included in that suite of standards is statement 73. And 73 deals with pension issues, primarily focused on pensions that don't meet the criteria set forth in either paragraph 3 of statement 67 or paragraph 4 of statement 68. And that is, what qualifies as a trust. So, sometimes there are plans at the state level, generally associated with highly compensated employees, where there isn't where the assets are not held in trust. So 73 primarily focuses on how to account for those activities, and the end result is, or the bottom line of the guidance is it's exactly like you find in 67 and 68. However, what it did, by issuing the standard, it did provide us an opportunity to go in clean up a couple of minor issues. Now, timing is everything, right? And some of the issues that, like the covered employee payroll, it hadn't bubbled to the surface as we went through the due process on Statement 73. So that issue isn't addressed there, but we did cover some minor things in Statement 73. Now, is there something beyond the horizon? Again, as I mentioned before, I wish I had the crystal ball. During my period here at the GASB, all I can tell you is my crystal ball has become more and more cloudier. And to say that the board's going to do this or the board's going to do that would be completely inappropriate, because only the board is going to make that decision, and they're only going to make that decision after extensive due process. So there have been, I would consider nothing's ever minor if it happens to apply to you. So, I don't want to classify it, but there have been some issues that have been raised. The board will discuss those issues with our advisory council in July, and those issues, include this covered payroll issue, it includes that 30-month issue that I mentioned before. And also, there has been a call by some to, for us to, again, to relook at ARC, the ARC. And we'll raise all of those issues with our advisory council. And based on feedback that we get, the board will make a decision on whether something should be considered in the future or not. So like I said, I'm sitting in beautiful Norwalk, Connecticut, not in Nevada, so I won't place any odds on how any of those will go.
All right, thanks, David. I've got two more questions I'd like to get to, both again around census data and employer auditors and plan auditors. And Jerry and Donna, I think we can get both of them in here. The first one is, if there is an indication that the auditor of the pension schedules may not have followed the white papers in testing census data, what steps should the auditor, the employer auditor, take to ensure the opinion is appropriate for their purpose?
Well, that's a good question, and one that I fortunately haven't had to deal with. But I think if I did have to deal with that, I think you're going to have to look at the controls over the census data and get further information about what the actuary actually used in the calculation. I mean, there's so many parts of the pension calculations that you as the employer government really are responsible for knowing whether that information is at least reasonably correct, and the census data is a big piece of that. So yes, if you don't think they followed the suggested guidance in the white papers, or you don't think that they audited enough information about the census data and it's not clear whether or not the actuary was using correct information, you're going to have to find a way to audit it.
Thanks, Donna. Anything else, Jerry? I know that's not your case in Tennessee.
No, it's not, but I think Donna is correct, because the white paper basically says that there are a few other alternatives, but they are recommendations. It is non-authoritative, so the employer auditor has the ability, in this case the plan auditor, I guess, has the ability to do other things, but to ensure that they do meet the objectives, and that is an opinion. And they have to document that, where they have, because this is kind of interpretive guidance and of the standard, so to speak, that they're going to have to basically, I'm assuming in this case they're saying that they know that is to be the case, where they didn't follow the white papers. And if that is the case, then they will need to basically find out what else the other auditor did to meet the objectives, and find out if they consider it to be reasonable. Because if they don't, Donna's right, then in that case the employer auditor is going to have to do additional work.
Yeah, and I think this next question is from the same person probably, but should the employer auditor go as far as asking the plan auditor who issued an opinion on the pension schedules if in fact they tested census data before relying on their opinion?
Well, I personally think there should have been a dialogue opened up already to have that conversation and to make sure that what they were going to be doing was sufficient, because as the employer auditor, they're the ones who are responsible to determine that they have sufficient appropriate audit evidence. So, yeah, I would open up a dialogue, and if you have to, even with the actuaries.
Yeah.
Well, and even on the other side of it too, I mean, I think Donna's correct. The communication is extremely important, and it goes both ways. The plan auditor is going to have to rely on, well, at least in our case, where within our office, LGA and the CPA firms are doing the census data test work of the active members for the employer, participating employers. You know, we're relying on that evidence as well when we're doing our test work, and then they are relying on what we've done to support their evidence. And so for us, it's going both ways. In this instance, you have probably a CPA firm that's doing one part of the equation and the auditor's office doing the other part of it. And that has posed a challenge, and not only in that situation, but also where even at the plan level where, say, for instance, the state audit organization is auditing the plan, but a CPA firm is auditing the schedules.
Right.
That situation has come up as well. So that communication is going to have to be present, even though group audit situation doesn't apply here, per the interpretation of the white papers. You still are going to have that conversation just to see if you can gather enough information to determine whether or not that auditor did enough to where you can rely on it. And if not,
thanks, Jerry.
And if not,
I think I can squeeze one more, Jerry, and this one's specific to you. And David talked about beginning balances and, you know, the rollback and all that. On one of your slides, Jerry, you had the TPL beginning balance was $20.3 billion. And the question is, how did you guys determine that beginning TPL balance? Can you just summarize in general terms how you guys went about that?
I could summarize it very quickly. I don't know.
And that came to you from Treasury, I guess?
Kenny, in our case, the actuaries of our plans came up with that beginning net pension liability, the total pension liability minus the fiduciary net position. Came from the actuaries calculated the total pension liability at June 30, 2013 as well.
Okay.
And that might also be the same case for us, but I'm not for certain.
Don, are you doing anything specific to determine the accuracy of that? Or are you relying on the actuary?
Our plans are including that in the schedule of employer allocations, and the auditors are issuing opinion on those totals. All the collective net pension liabilities and deferred inflows and outflows of resources.
All right, very good. Jerry, real quick, a lot of folks...
If the questioner wants to send me that question, they have my contact information, and I will verify that for them. Okay,
very good, very good. Real quick, Jerry, a lot of people out there today probably wondering about the AICPA audit guide, you know, state and local government audits. We've heard that there's going to be a new chapter on pensions. Some rumors have that it's being a pretty significant in terms of number of pages. Can you just give us just a general update on where that's at?
Yes, at least for the task force that's reviewing those chapters and the guide itself, that is complete. That finished up in early May, and we should have a final document tentatively. I think it's next month, so June, probably by the end of June. The chapter will be divided into two parts, one for 67 and one for 68, and there will be quite an additional amount of information that's in it. To kind of give you a sense of it, if people are familiar with the employee benefit plan audit guide, that will give you a sense as to what's going to be in this chapter. It will give you specific procedures. They are all recommended, and so you don't have to do them, but you may have to justify, because this is an interpretation, you may have to justify why you're not doing those procedures. And in our case, we have looked at the EBP types of procedures and determined that those are reasonable and likely will include some of those in our audit procedures as well. The white papers themselves will be incorporated as appendices within that chapter as a whole. So it's going to be a comprehensive chapter, but I think it's going to provide a lot of additional information that's going to be quite beneficial.
All right. Thank you, Jerry.
Does that help,
appreciate
Kenny?
that update. I know that was probably a question on a lot of people's mind. We are right at the limit and probably pushed it over the limit just a little bit. Let's go ahead and wrap up. That concludes our webinar on GASB 68, Accounting and Auditing Issues. Implementation is coming soon. I want to thank our speakers, David and Jerry and Donna, again, for sharing their knowledge and experience with us today. And also many thanks to Anna Peniston of our staff here at NASAC who helped make today's event possible. Before we go, just one last check of attendance. If you would, as you can see on the slide now, just complete this last test, and that is just type in, I have completed the webinar in your chat toolbar, and once you've type that in, just hit the send button, and that way we will have a record of your attendance, one additional piece of documentation. Again, this does not apply to groups, just to individuals. And just as a reminder, for those of you wishing to claim CPE for today's training event, don't forget to complete and mail your CPE forms as well as the sign-in sheet to NASAC. The mailing address is listed at the bottom of your sign-in sheet. And for those in group settings, please don't forget to have your room monitor sign the sign-in sheet attesting to everyone's attendance today. One last thing, we are using an electronic evaluation form in an effort to make our processes more efficient. Room monitors, please make sure you provide that link to the evaluation form to everyone in your group, and those participating as an individual, you should have received the link directly from Anna Peniston of our staff. Hope everybody enjoyed today's webinar. It's a very timely, informative session. In terms of future webinars, just real quickly, NASAC's next webinar is scheduled for July 8th, where we will be having our annual GASB review, GASB Review 2015. More details will be available on our website very soon. The Association of Local Government Auditors is holding their next webinar on June 16th entitled Professional Skepticism. If you're interested in that topic, you can look at ALGA's website at www.algaonline.org. And lastly, our colleagues at AGA, they're conducting a webinar on June 3rd entitled Update and Implementation Issues of the Data Act Beyond the Beltway. More details on that event can be located at the AGA's website, which is www.agacgfm.org. Again, I want to thank everyone for participating. Thanks again to our speakers today, and I wish everyone a great afternoon.
Thanks, Kenny.
Thanks, Kenny. Are you guys still on?
Yeah, are you the only ones that we can hear?
I guess it's just you and me, Jerry. We didn't hang up yet.
I guess so. Everybody else was ready to get off.
Yeah. Well, you did a good job. Thank you.
Oh, you did too, Donna. You had a fabulous